The global growth team is always searching for a specific type of growth company. We are searching for companies due to their business models or due to the products and services they are offering, they are in a position to achieve a structural growth phenomenon, providing us with great visibility about future earnings and cash flows, mostly independent of the state of the economic cycle, and always able to mitigate any of the external factors that might arise in the future. So the short answer will always be yes. I think it's always a great time to invest into structurally growing companies. We are not restricting ourselves to specific sectors or specific countries in finding the greatest opportunities to add to the global growth portfolio. But there is a tendency that we do find most of our attractive candidates in more, let's call it, diverse or heterogeneous sectors. So at the current time, there are a lot of opportunities in the healthcare segment, namely in the medtech segment of the market. Or when you think about the technology sector, the current name of the game is the semiconductor industry. When people are talking about autonomous driving, Internet of Things, 5G, connectivity, there is a super huge demand for semiconductors. And there are companies globally that are catering the needs in a perfect way and that enable us to invest our clients' money into some of the greatest companies on that planet. For example, there is a quasi-monopolist who is building lithography machines with the latest art of technology that is enabling semiconductor manufacturers to go even smaller and smaller and smaller sizes for the semiconductors, while at the same time increasing the computing power that can be done on that semiconductor, on that computer chip. So there are also other companies from the US or from Switzerland that are catering these industries, that industry, and that are profiting from that term structural growth in the need, in the demand for semiconductors. So there are plenty of opportunities out there, and we are there to capture them. You have to look at valuation through two different pairs of eyes. On the one side, we make use of valuation when it comes to portfolio changes, when it comes to adjustment of position sizes. Quite simply said, if a company is too rich in its valuation, we are rather cutting our position size. Whereas when valuation is getting too low, we are rather adding to our positions. You should not really compare the valuation of the market to the valuation of the portfolio, because we are talking about two different pairs of shoes. The market in itself is rather made up of cyclical companies, where the luck and the fate is dependent on the overall economy.